A man retires with $1.4 million. He did everything right, paid off the house, maxed his 401k, never touched the principal. 18 months later, he owes the IRS $62,000 he didn't know he had. Not because he made a bad investment, not because the market crashed. Because nobody told him that saving money and keeping money are two completely different skills. This is the part of retirement nobody puts in the brochure. The one where the IRS doesn't stop being your business partner just because you stopped getting a paycheck. 10 mistakes, every one of them legal, every one of them is common, and every one of them expensive. Let's find out how much they cost. Why this matters now. Here's the uncomfortable timing. Right now, roughly 4.1 million Americans are turning 65 every single year. The largest wave of retirements in U.S. history is happening in real time, and most of it is walking straight into a tax system built for people who are still working. That's the trap. The tax code assumes income. Retirement removes the paycheck but keeps the tax machinery running in the background, quietly, automatically, on a schedule you didn't set. And the accounts that were sold to you as the smart, responsible choice, the 401k, the traditional IRA, were never actually tax-free. They were deferred from tax, which is a polite way of saying the bill was never canceled. It was postponed, with interest in a sense because the account kept growing the whole time. So the mistake isn't saved. The mistake is not understanding when the bill comes due and who decides that timing. Spoiler, it's not you. How the system actually works. Let's strip away the jargon. Every dollar you put into a traditional 401k or IRA skipped taxation on the way in. That was the deal. The government let you defer it in exchange for one condition. Eventually, you must take it out, and eventually, you must pay tax on it. Eventually has a legal name. It's called a required minimum distribution, and it kicks in at age 73. At that age, the IRS doesn't ask if you need the money. It doesn't ask if you're still working, still healthy, still married, still caring. It calculates a percentage of your account balance and it forces you to withdraw it, whether you want to or not. That withdrawal counts as income. That income can push you into a higher bracket. That higher bracket can trigger other costs you never saw coming. This is the number one mistake. Treating the RMD like a future problem instead of a math problem you can solve for today, years in advance. Because by the time you're forced to take the money out, it's too late to plan around it. You're just reacting. Now here's where it gets interesting. Here's where good intentions turn into expensive mistakes, one after another, like dominoes nobody set up on purpose. Mistake 2. Ignoring what's quietly nicknamed the tax torpedo. Most retirees assume Social Security is either tax-free or lightly taxed. It isn't. Depending on your combined income, up to 85% of your Social Security benefit can become taxable. The formula is strange. It phases in aggressively over a narrow income range, which means a small amount of extra income can cause a disproportionately large tax hit. People call it a torpedo because it hits fast, and it hits hard, right in the middle of what should be a quiet financial season. Mistake 3. Doing Roth conversions too late or not at all. A Roth conversion means paying tax now on retirement money, so it grows tax-free forever after. Done in the right years, usually the gap between retiring and turning 73, when income is naturally low, this can save tens of thousands of dollars over a lifetime. Done never because it feels weird to voluntarily pay taxes. It guarantees a bigger, less controllable bill later. The irony here is almost poetic. People spend their whole working life trying to avoid taxes. Then they avoid the one move specifically designed to avoid more of them. Mistake 4. Withdrawing from the wrong accounts in the wrong order. There's a sequence that minimizes tax drag: taxable accounts first, tax-deferred accounts next, Roth accounts last. Most people withdraw based on convenience, not strategy. Whichever account is easiest to access, or whichever one had the best year. That casual approach can accelerate taxes by years, and nobody notices because there's no single moment where it feels like a mistake. It's death by 1,000 small decisions. Mistake 5. Triggering IRMAA without knowing it exists. Here's one almost nobody sees coming. Medicare premiums aren't flat. They're income-based and they look back for 2 years. So, a large withdrawal, a Roth conversion, or a lump sum today can silently double your Medicare premiums 2 years from now. It's a stealth tax with a 2-year delay fuse. People call their financial advisor confused, asking why their Medicare bill suddenly jumped, having completely forgotten the decision they made 2 years earlier. Mistake 6. Getting state residency wrong. Retirees move for weather, for family, for cost of living, and they assume their tax situation moves cleanly with them. It doesn't. States have different rules for pensions, for retirement account withdrawals, for residency requirements. Some states will still claim you as a resident, and therefore a taxpayer long after you've technically left if you didn't sever ties properly. Keeping the old driver's license, just in case, has cost people actual thousands of dollars. Mistake 7. Bunching capital gains without a plan. Selling a rental property, a business, a concentrated stock position all in one calendar year can spike your income so high that it drags every other tax mechanism along with it. Higher bracket, higher Medicare premiums, more of your Social Security taxed. One transaction, 4 separate consequences, arriving through 4 separate mailboxes over the following 2 years. Mistake 8. Keeping tax-inefficient investments in the wrong type of account. This one's almost invisible. Bonds and REITs generate income that's taxed every single year. Growth stocks don't until you sell. Put the income-generating assets in a taxable account, and you're paying tax annually on money you're not even using yet. It's not a mistake anyone notices in the moment. It's a slow leak, not a burst pipe. Mistake 9. Outdated beneficiary designations. A retirement account doesn't follow your will. It follows whatever form you signed, possibly decades ago, sitting in a filing cabinet where nobody's opened since. An ex-spouse, a company that no longer exists, a beneficiary who passed away years earlier, all of it can still be legally binding. And when heirs inherit through the wrong structure, they can be forced into a compressed, 10-year withdrawal window that triggers a much larger tax bill than necessary. Mistake 10. Giving charity the expensive way. Writing a check to a charity feels generous, and it is. But for retirees over 70 and a half, there's a mechanism called a qualified charitable distribution that lets you send money directly from an IRA to a charity, and it never counts as taxable income at all. Skip that mechanism, and you're donating with money you already paid tax on when you didn't have to. 10 mistakes, none of them dramatic on their own, all of them quiet, all of them legal, all of them expensive. Hype versus reality. The financial industry loves to sell retirement as a finish line. Cross it, relax, done. The reality is closer to switching leagues mid-career. The rules didn't disappear. They changed. And most people are still playing by the rules from their working years, using a strategy built for a paycheck that no longer exists. The hype says, save enough and you're safe. The reality says, how you withdraw matters almost as much as how much you saved. 2 people with identical account balances can end up with wildly different amounts of usable money, purely based on sequencing, timing, and a handful of decisions most people never think to question. That's the quiet joke buried in all of this. The industry spends decades telling you to accumulate. It takes almost no time telling you how to spend it back down without giving away more than necessary. Zooming out. Individually, each of these mistakes looks small. A few thousand here, a slightly higher premium there, nothing that ends a retirement. But stack them across 20 or 30 years, because that's how long modern retirements last now, and the numbers stop looking small. Some studies estimate that poor tax sequencing alone can shrink a retirement portfolio's lifespan by 5 to 10 years, compared to an identical portfolio manager with intention. 5 to 10 years. That's not a rounding error. That's the difference between running out of money at 85 or making it to 95. And here's the part that should genuinely unsettle you. None of this requires bad luck. No market crash. No fraud. No health crisis. Just ordinary decisions made without a map, compounding quietly in the background for 2 or 3 decades. The system isn't designed to trick you, but it isn't designed to protect you either. It's neutral. It rewards precision and punishes assumption, without ever raising its voice to tell you which one you're using. So here's the question worth sitting with. If the tax code doesn't care whether you understood it, if it collects the same either way, how much of your retirement is still in your control, and how much of it was decided the day you stopped asking?